Greetings from 3Edge Asset Management. My name is Fritz Folts, and I'm the Chief Investment Strategist here at 3Edge. And I'm pleased to be joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. Today is Saturday, May 30th. And as Steve and I have done each week during the COVID-19 crisis, we will be providing a brief recap of the past week in the global capital markets. And then we'll look at a particular topic that we believe might help investors better understand the current environment. As a reminder, all of our videos are available on our YouTube channel, and always feel free to share these videos with anyone who you think might be interested. So let's get started. Yesterday marked the end of the month of May, at least for the equity markets, and the US equities advanced with the S&P 500 up approximately 3% for the week, recording its second consecutive positive month. So equity investors seem to remain convinced that the reopening of the economy will lead to a V-shaped recovery, or perhaps that even if the economic rebound disappoints, there's still a belief that the Fed has the markets back, at least for the time being. Meanwhile, on the economic front, on Thursday, the Labor Department actually reported some good news. The number of jobless individuals actually declined by approximately 4 million for the first time during the coronavirus pandemic, in a sign that people are actually starting to return to work. However, obviously, the economic damage from COVID-19 is still profound, with the US reaching the tragic mark of 100,000 deaths from the virus this past week, and with over 40 million Americans having now filed for unemployment benefits over just the past 10 weeks. Then on Friday, the Trump administration continued to ramp up tensions with China, threatening to punish China for its recent steps to curb Hong Kong's autonomy. However, investors seemed relieved that there were no new specific actions forthcoming from Washington, at least not yet. So let me bring Steve in to our conversation. And Steve, I've heard you describe the period, this period of the COVID-19 global pandemic as one of radical uncertainty. And I really like this description. It sums up the current environment and the heightened degree of uncertainty surrounding the path of both the economy and the markets. And importantly, it doesn't rely on having to use the word unprecedented, which we've had to do over and over again during this period. So this week, I want to talk about global diversification and why it could be particularly important in the current environment. And not just to manage risk, but also to seek to generate investment returns. Our clients are aware that we use broad global diversification. It's a hallmark of our investment approach here at 3Edge. And one of the interesting features of the markets today is, to me, is the sense that if the markets are supposed to provide us with an indication as to how things will play out in the future, then it seems to me anyway that there's substantial disagreement between the different asset classes, between stocks and bonds, for example. So I thought maybe it would make sense to first actually look at each different major asset class one at a time and see what signals are investors receiving from the equity markets. And then what is the bond market signaling? And how are those signals different and why? So let's begin with equities, which have rebounded obviously from their March 23 lows. Are equities signaling that a V-shaped economic recovery is the most likely outcome for the economy? Or is it simply a function of the Fed seemingly buying everything in sight that has propelled the relief rally in equities so far?
Well, Fritz, if 10 years ago, you took me into a room and showed me your crystal ball to see what would happen 10 years from that point, and if all we looked at the beginning was the equity market, we would see equities in the midst of a very strong rally. And I would have to conclude that based on the equity market, the economy must be going through a very strong recovery, or it's expected to go through a very strong recovery sometime soon.
So then let's shift to the bond market, because perhaps the bond market is in disagreement with that, with the equity markets. Is the bond market signaling that the probability of a lengthy period of slower growth and lower inflation is what's in store? Or could it be that basically the bond market is just held captive by the Fed, which is determined to keep rates low at all costs? What's the bond market telling investors now?
So if we went back to that room 10 years ago and you showed me the crystal ball, but only allowed me to look at the bond market, I would say, Fritz, the 10-year Treasury yield is only around 0.6%. The economy must be in a deep recession and maybe on the way to a deflationary depression.
The definite disagreement there. So now let's look at real assets and see if we can decipher what the market for real assets, which would include gold and commodities, what does that market seem to be anticipating? I mean, certainly the price of gold is up, I believe, in the range of 14% this year. So it seems that maybe the attractiveness of gold is saying that investors believe that we're in store for even more government debt and money printing.
So one more time, I look into the crystal ball 10 years ago, and all you show me is the gold market. My conclusion would be, if gold is the best performing asset class in 2020, better than bonds, better than stocks, then my conclusion would be there must be financial instability, or maybe geopolitical instability, or maybe a strong fear of inflation. So again, very different than the other two markets.
Okay, so here's the harder part. And first, I want to reintroduce a slide that we used 2 weeks ago, which we refer to as our market cycles or our compass chart. And I just, this chart is a useful guide in terms of thinking about which asset classes may outperform depending on where we are in different market cycles. And so with this chart as a guide, could you explain how investors might interpret the different signals coming from the market? And importantly, what does that synthesis of these disparate signals look like? And how are we positioned based on that information?
So right now, as you point out, Fritz, three major markets are giving very different signals, probably more in conflict than any time I can remember. But there is a common theme that ties them all together. And that common theme is whether you talk about the stock market, the bond market, the gold market, they're all priced in US dollars. And the Federal Reserve Board is able to manipulate the quantity and value of US dollars in a temporary way. So they have engaged in the most extraordinary burst of monetary creation in just the last couple of months. That has lifted all the markets. And while they can't raise revenues, they can't get people to go buy and spend money, what they can do is that they can change the unit of measure that stocks, bonds, and gold are all measured in, and that is dollars. And so I'll give you an analogy, Fritz. Let's suppose that we declared a national emergency, and it was decided that people just weigh too much, and everybody needed to chip in and weigh less. Well, there are two ways to do that. One is that people, by and large, eat less and exercise more. The other way is we decide we're going to change the scales. So what used to weigh 200 pounds now weighs 180 pounds, and we can all feel lighter. That's an analogy. That's akin to what the Fed has been doing, which has been a temporary change in the quantity of dollars that have flooded all the markets. Now, I say temporary because over time, the Fed just can't print its way to prosperity. It's a bridge, hoping that in a short amount of time, the economy will take over and things will get back to normal. But because, as you mentioned, we have radical uncertainty, we have a pandemic where it's pretty certain that things are getting better, that we're past our peak. But what's very uncertain is, are we going to get a resurgence? Will there be a second wave in the fall? Right. It's hard to know how confident consumers will be or how cautious they'll be in getting back to normal. So with this range of uncertainty, we know that there's a range of possible outcomes. And while the markets are all signaling very, very different outcomes, any one of them might be possible, but it's based on decisions and events that haven't happened yet. So getting back to your question about how does one invest in such a period of radical uncertainty, what we would say is that the wrong thing an investor could do is act as a gambler, be overly confident that that investor knows exactly what the scenario will be, and put all their investment eggs in one basket. In other words, I think it would be overly confident to say with absolute certainty that the economy is going to come roaring back in a few months and we're going to be back to normal and beyond. If that were the case, you would put all your money in the stock market, but we don't know that for sure. Similarly, I think it would be a mistake to just conclude with 100% certainty that we're going into the Great Depression. So So our message is that there is uncertainty, that there's value to have some part of your portfolio protecting you across all those different scenarios we discussed. But then beyond that, we use our models, our research, our analysis of the cause and effect relationships that affect these different asset classes to best place what percentages should be in each asset class, but not to be gamblers, not to put it all in one.
Excellent. That's a very good description. Thank you very much. And now, before we go, I would like to briefly share one more chart, which I've always found to be interesting. Oftentimes, investors, when they think about broad diversification across asset classes, they think about it in terms of a risk management tool. And diversification is an important way to manage investment risk. However, it is also a means to generate investment returns thanks to what we refer to sometimes as positive drift. And so if you take a look at this chart, it shows the average annual investment return for many different asset classes, including US equities, non-US equities, bonds, commodities, gold. It goes all the way back to 1972, up through April of 2020, the end of last month. And the last column on the right is the average rate of inflation during that period, annual rate of inflation. And so what is interesting is all these very different asset classes all achieved an annual investment return that outpaced inflation. They were able to generate positive real return. And so what we see here in this chart is that while asset classes tend to go up and down at different times, over a longer time horizon, they all tend to exhibit positive investment returns or positive drift. So diversification doesn't just help with risk management, it can also be additive to returns. And that's important for investors to keep in mind. So that will do it for us. Steve and I will be back next weekend with another edition of our 3Edge Weekend Update video. And remember, all of our videos available on our YouTube channels. Please feel free to share this video if you feel someone might be interested in listening. And so on behalf of Steve and everyone at 3Edge Asset Management, we urge everyone to do everything possible to remain safe, stay strong, and keep the faith. And thanks for listening. And Steve, thank you so much for your time today.
Thank you.